I'm Scott Loveridge, Director of the North Central Regional Center for Rural Development, and I'm your moderator for today's session. Our presenter is Dr. Abner Womack. He's Professor Emeritus of Agricultural Economics and serves as Research Professor with the Food and Agricultural Policy Research Institute, FAPRI, as you see there on the slide, at the University of Missouri, and he's a co-founder of the Institute. He previously served as a co-director of FAPRI and also as director of the Agricultural and Food Policy Center at Texas A&M University. He's a recipient of the Charles A. Black Award from the Council for Agricultural Science and Technology. So welcome, Abner, and looking forward to your presentation today.
Special thanks to you, Scott and Rosa at Michigan State, and Mark Stilwell and Mary Lucy here at the University of Missouri for coordinating this effort and providing the opportunity for me to share some ideas about the economic crisis with you. In the extension tradition, conclusions that I have drawn reflect a work in progress over the last 2 years, and I've definitely benefited from several working sessions with colleagues like yourself and the business, banking, and legal community, plus presentations to the general public as part of our outreach responsibilities. Thanks to all of those that are helping with the organization today and for you in joining in, my presentation is going to be in really 2 parts. And to think of the first part as a macro from the top looking down on the economy, where we look at the factors that have influenced the likely consequences and recovery time if, under the condition, the stalemate in D.C. over policy stimulus packages to recover remain at a stalemate. So that's kind of the first part. What are the contributing factors, the consequences, and how long before recovery is under a stalemate? The second part is a result of working sessions that I've had with bankers and business community and the colleagues, and that is to take a longer run view of policies implemented in the past, that this Great Recession seems to be similar in nature to the Great Depression and has been fueled by excessive speculation and debt overload, just like we got into during the Depression. So I found in the working sessions with the business community and colleagues that programs used in the past to jumpstart the economy served as a basis for stimulating dialogue on strategies to further jumpstart the economy, create jobs, and lower pressure on the deficit. So the level of the debt is the dominant factor. The substantial debt in all 4 sectors of the economy, and you can think of this in a macro sense as a 4-legged stool that in the aggregate that the economy stands on. The demand side comes from the household sector. The supply side is from the corporate sector. The financing is provided by the banking community, and the government provides services, regulations, and security. And I just say, and listen to some of the dialogue along the way, it certainly is easy to get this out of focus if we do not recognize the basic principles of supply and demand complemented by the financial and the government sectors. Other contributing factors besides the debt is, I'm going to focus on the consumer a good deal as we move through this, because 70% of the economic activity is associated with how the household is doing, and the fact is the consumer is not doing very well. And if the consumer doesn't buy big ticket items like automobiles and houses, we have a very slow road to recovery in front of us. And there's plenty of room for continuous concern. Even though we have this heavy debt as a major factor, there are additional lingering problems that contributed to the recession. They still remain in the background and could bring us down again. And we'll discuss those in further detail as we go along. Now, how we got here on the first part, the Financial Commission that was put together by President Bush and then the administration later was a year of study, and they made the report to Congress in January of 2011, and they pointed to 4 areas that really brought down the economy. And they suggested it was failure across 2 administrations. The corporate side mismanagement contributed, but the big one was the heedless risk by Wall Street bankers, and this is a very significant statement here, easy to overlook, that they loaned at a rate of $40 in assets to $1 in capital. That's like putting 2.5% down when you go in and make a big loan. And then failure by the government to provide regulations. And now, I wish that, and I was talking to Scott earlier and Mark here, that I wish that I had done this earlier on and I could have caught what was taking place, and probably many of us should have done it. And this is just an example of how the banking industry over-leveraged and then dropped us off the cliff. And the way I've done this is in this first row here, I have that, suppose you decide that you want to invest in the housing business, and the boom is starting in 1950, and you walk into your banker and you say, I want to get started, I want a $200 investment, and the banker says, well, I'll go with you 50-50. So that means you're going to have to come up with $100,000. The banker's going to be responsible for $100,000 against what you're building. And generally, if everything goes well, the banks will get about a 1% profit. So this bank, being very conservative, has limited himself somewhere to about a $2,000 profit, but not taking very much risk. But if you walk down the street and the next banker says, I am a little more optimistic about the housing business, and I'll lend you at 25% down, suddenly your $100,000 turns into $400,000. The bank puts $300 on the table, a quarter of $400 is your $100,000, and they stand to gain if the business is successful about $4,000. But look at how this thing magnifies. You dropped a 10% down, the $100,000 now is a $1 million project. You've got $100,000 in the game. The bank's got $900,000. They stand to gain 10. It even went to 5% down, and that $100,000 now turns into $2 million. And at 2% down, this $100,000 turns into $5 million, and we actually had 1% down and nothing down. Well, at 1% down, $100,000 is $10 million. And so what began to happen, you can see over on the right-hand side, that the big bankers became brokers, and they were looking at the profit they could get from the turnover, and then they were collapsing those mortgages into derivatives and selling them on the world market and trying to get somebody else to take the risk. And so what became apparent is that when you look from 1 to 6 down, that the banks began to look at their profit item as a broker and began to back away from the fact that they had shifted the burden on themselves relative to who was bearing the risk. As you go down the line, the bank has taken substantial risk. So you notice the shift and who's bearing the risk, and then the question then of what happens when the market falls 20%, and many of those big banks simply weren't carrying enough capital to make up the difference. And they shifted the responsibility to you and I, and we made up the difference, and they were too big to fail. So bigger banks have an incentive to hold low capital, knowing that they are too big to fail, and if necessary, we'll come in and bail them out. So they began to look at the right-hand side of that little table rather than the risk side that they really were subjecting themselves to. So how bad is this debt? Now, this was very hard to come by. All of us knew that when they came on TV in the fall of '08 and said we're going under unless we bail out the banks, they have so much debt that we had a problem. But if you turned around and tried to find any indication of debt, it couldn't be found. This little chart came out about the end of 2009. And it was first insight we began to gain on the magnitude of the problem. And they were suggesting in 2009 that the debt was about $52 trillion. It's hard to even imagine what that means, but they use a reference point with regard to debt across time, and that's how much debt relative to the value of all the goods and services we produce in 1 year, and that's called GDP, and at that point in time, it was 3.8 times the level of GDP. So the first thing you notice about this chart, starting in 1925, going across to 2006, is the magnitude debt on the right-hand side is substantially larger than it was during the Great Depression in 1933, where the yellow peak is. The second thing you notice about the chart is this green area. This suggests a philosophy from 1930 to 1980 that pretty well prevailed. The debt was public enemy number one. So you had pretty tight banking regulations, and you also had to put down a pretty good deposit in order to get a loan. And then the philosophy shifted in 1980, the red area, and this is more of a debt leveraging philosophy, and it was the basis for the business model stimulus for more growth. And so the third question with regard to this chart is, where is the equilibrium? If we now have too much debt, how far do we have to fall before recovery? And this got great debate amongst the business and banking community that I've discussed this with. Nobody knows the answer to it, but most of them said, suppose we dropped it down to 100 points. how long before recovery? Well, you can begin to get a handle on that because in the last 3 years we've dropped about 10% a year. And so if this was the point where we could expect some recovery to begin to take place at 280, drop 100 points, then that means 10% a year, 10 years in front of us, somewhere at the end of the decade. And finally, a thing to notice is that philosophies make a big difference. It has a long shadow, and like a pendulum, it tends to swing too far in one direction only to do the same thing in the other direction. Okay, now that's total debt. That's putting all the households together with the corporate financial sector and the government sector. So the question now is, who holds all this debt? And finally, the Morgan Stanley people came out with this chart later on in 2010 that's a better indicator of who really is holding the debt. So you can see the left-hand side going to about 300% in 1933. And then on the right-hand side, when we get out to 2008, you can't see it at the top across the administrations that I have listed there, but we were about 380% of GDP. Now notice that we have all the administrations on this chart: FDR, Harry S. Truman, Ike, Kennedy, Ford, Reagan, Bush 1, Clinton, and Bush 2. So you can see the momentum as you move across the chart with the two philosophies, and then when you get to the right-hand side, 27% of that debt is held by the households, 22% by the corporate sector, furnishing the products to the household, financial 18%, but they have fingers all down into 22 and 27%. The GSE is Fannie Mae and Freddie Mac, and the blue area at the top is the federal government. Now, if you collapse Fannie Mae and Freddie Mac into the federal government, that is 1/3 of the debt. The rest of it, the financial, the corporate, and the household sector, is 2/3 of the debt. And the interesting thing about that is there's a substantial amount of finger pointing towards the government as being the culprit for the major debt, but the fact is that most of it lies within the public or the private sector. So the business model leaned heavy on debt for growth after the 1980s. We repealed the Glass-Steagall Act of the 30s in 99, and this is very important if you look at 1999 and look at the magnitude of increase in debt at that point. And the argument was that the Glass-Steagall Act put in place after the Depression was too stringent. It required banks to hold a base level of capital that they considered to be conservative, and had the regulators to come in and back it up, and the argument was the business model was working so well we didn't need it anymore. So notice the spurt in debt afterwards, and that it brings down the economy finally in 2008. So the financial model worked, but finally failed because of excessive speculation and the high energy prices and other factors have contributed. And there are now opinions about where we are, and one of them that is very insightful is by Tom Horning, who is the recent president of the Kansas City Federal Reserve. And he's pointed out from his perspective that we've done very little to prevent a repeat of these events in the near future. And he does this by indicating the distribution across small and larger banks. And he suggests that in 1930, we had 21,000 commercial banks. The 5 largest control 2.5% of the assets, the business. 1980, 14,000 commercial banks, 5 had 14% of the business, but look at the jump between 80 and 2010. 7,000 commercial banks, 5 of the largest with 60% of the business, and 20 of the largest had 86%, and he says several of those 20 largest nearly brought the economy down. So he's not comfortable with where we are, and you get the same statement from Borowski, the Special Inspector General for the TARPs. He managed the money that we loaned to the banks, and he reported to the Wall Street Journal in the summer of 2011, in March of 2011, that the same 2 big to fail firms that nearly brought down the U.S. financial system in 2008 has become even more interconnected and continued to maintain an unfair advantage over small banks. That last statement is very important. He's suggesting they're still carrying a very low capital rate that implies tremendous risk to us in the future. Now, some of the fallout for this, unfortunately, when the banks did it, are these sets of charts that were put together by the Kansas City Federal Reserve. This is what the economy looks like when we have a 5% unemployment rate. The purple is about 10% in that region, red is about 5%, and yellow is about 2%. So this chart would reflect the magnitude of unemployment at different levels that average about 5%. Look at the change that occurs whenever we move to 2008, how quickly this begins to change. This would reflect about an 8% unemployment level, and then move to 2009, a 10% unemployment level. 10% unemployment is about 15 million people. There are also about 7.5% that are marginally attached plus part-time, and according to the Bureau of Labor Statistics, that's 11 million. So the total here would be 26 million people, but that isn't the stopping point. For every person that has a job, about 2.4 are attached. And so if you multiply 2.4 times 26 million people, this is 62 million that are impacted by this downturn, severely impacted. Now this is a massive problem because 62 million out of 310 is 1 out of 5. And if you go back and check the Depression in 29, 1 out of 4 was the number. In 41, it was 1 out of 3. So we're closer to a massive problem than we might imagine. And currently, to back that up, if you look at other statistics, 1 in 7 are on food stamps. And currently, for every job available, 4 are looking. So 14 million jobs were lost. And multiply that times 2.4, that would be 33 million people, men, women, and children, that have been impacted. They're living off of welfare and food stamps, and the fact is we bailed out the bank, but we seem to be pulling away unemployment benefits. To get another shot at this, I think this is very important because we talk about total unemployed. That's the numbers down in the bottom right-hand side of this chart. The civilian workforce is about 155 million, employed 142, suggests an unemployment at 13 million. But if you go for the others, marginally attached and the part-time, those numbers are substantial in magnitude, going to 27 million in January 2010, dropping to only about 24 million. So we've had a marginal decline in the overall level of unemployment. That bottom number probably dropped from about 15 to 13. Now here's the second part of the equation. The other contributing factors has been the divergence of wealth and income. And this depends on the top 1% of the billionaire problem. And what we'll show is that the economy still turns on the consumer, 70% of the activity, but 1% of the wealth is held by 35%. 35% of the wealth is held by 1%. And they've gained 15% since 1980. And the top 10% of the households have 48% of the income, gained 13% since 1980. And you can see that in these following charts. This is the billionaire chart, and 99% is in red on the bottom of the chart starting in 1920, and the top 1% is the top in gray. And notice in 1920 that the 99% had about 62% of the total wealth, gained to about 80% by 1980, and then it's declined to the point now that we're back at the same point that we started at in 1920. So the top 10% has gained a tremendous amount of ground. The same story is associated with the next chart on household income. This is the top 10%, and this chart's divided into 3 parts. The first part called the Great Depression 29 to 41, where the top 10% of the households had 45% of the income. Then the compression from 41 to 79 dropped back to about 33%, but since 1982 has gradually climbed back to the point that they're somewhere around 48% again of total household income. Another way of looking at this is the compression and the concern about compression that's taking place. This is an easy chart to read going from 67 to 2007. On the right-hand side is the percent of household, and on the left-hand side is percent of household income. And so at the very bottom, it indicates that 40% of the households have less than 12% of the household income, 60% have less than 28%, and 80% have less than 48% of the household income. That means that top blue area has been increasing over time, so the concern is over the pattern of income compression, more making less. And then the story doesn't stop there. With this next chart on how long will this last, again, the consumer is not doing very well, and this is a very interesting chart, very powerful. and it reflects a household debt to income from 1961 to 2009, and it certainly reflects a serious debt problem. The tight lending period from 1930 to 1980 represents an average debt load floating at about 60% of household income. And then when you get to the lenient lending period from 81 going to 2008, the average debt begins to climb. It's 64% in 85. You probably can't see those very well. It's 80% in 90. It's 100% in 2000, and it's 133% in 2008. So the strong growth model worked until it was over-leveraged, and the question now is, where is economic stability? And I've asked that over and over again to the bankers and business people. What are you comfortable with? Nobody knows that answer, but many of them will point to the line at 80%, that they don't think they will be comfortable in the aggregate sense. Depends on the person, but in the aggregate sense, they need to see things back at about the 80% level for comfort. Well, you can get another beat on how long this might take to get back down there. 130, we go to 80, that's 50 points, and the savings rate of paying back debt has been about 5% a year. So 50 points, if we continue that, at best would be 10 years in front of us, somewhere at the end of the decade. So the consumer's not doing well, and the economy will follow, but there's tremendous debt, there's tremendous unemployment, and now concerns about wealth and income losing ground. Other contributing factors that are a mystery to all of us when we look at them is what the Federal Reserve is doing and the other macros that are going on between trade and the rest of the world, and how that converges on our markets. And so to talk through where these come out, there's just simply concern about the pluses and minuses. For example, with low interest rate, what you and I know is that what the Federal Reserve is trying to stimulate the economy with a high debt. If you got $50 trillion of debt and you raise the interest rate 1%, that's $500 billion. So the magnitude of weight here is going towards the people that are holding debts. That would be the banks and the people that have the loans with them. And that's considered to be a stimulating factor, but on the other side of it is that we already have debt. So the dread is that we're trying to do the same thing we did before, creating a negative impact. And for those that are on retirement and beginning to try to live off their retirement paycheck, they're getting very little interest in return. That certainly isn't good for them. And then with regard to the exchange rate, both the exchange rate and the interest rate tend to move in the same direction. It's not exactly one for one, but with low interest rates, you tend to have low exchange rates. Well, that's considered to be a stimulus for the economy also, because whatever we export is at a cheaper rate on the world market. But the fact is that whatever we import, the prices increase by the same percentages, and we're a big user of world oil, so that's negative. And the other negative part is all of us are energy users, but not all of us gain from exports. So the fact is that there's not a lot of transparency over the winners and the losers here, and people would like to see more than that. And what plays into it is a global situation with China. China is simply not playing by the rules of economics to sustain their trade. They are holding their exchange rate artificially low. And so they're pushing more products into the U.S. market, and we're losing manufacturing and labor. And for us, the trade-off is cheap imports but lower paying service jobs. Neither of us can sustain this path in the world market, selling at low prices but buying high input energy prices. This is squeezing the labor market on both sides, and it could help push the U.S. and the EU into another recession, and it could pull China along with us. We need each other, balanced for growth. And then the next issue is energy, and this has several parts for concern, but this is most interesting in the one that I chose because it's recent projections by the Energy Information Agency. I believe this came out in January of this year, and it's a chart from 1980 to 2035. When you get over to 2035, it's very surprising to me, the estimated consequences. But they're suggesting by 2035 that 32% of our energy will be from oil, and 20% will be from coal, and 25% will be from natural gas, and the rest, 23%, will be from everything else. So at least they're suggesting by 2035 that 77% of our energy source is fossil fuel. So from this perspective, it appears that moving away from fossil fuels is likely to be a very slow process for the renewables and the liquid biofuels, and also for nuclear. The U.S. is fairly rich in coal. We think we have a 300-year supply at the rate of demand expected, and over a 100-year natural gas supply, but we are very tangled up over these issues relative to environmental safety and drilling and mining and carbon emission. So apparently, it's bringing on a massive level of alternative energy is likely to be a slow process, much slower than expected, and in fact complicating the situation as Congress failed to pass a comprehensive energy bill in 2009. So this is kind of like running the boat without a rudder, and it's equivalent to trying to ensure an adequate food supply without a farm bill, and it's simply an unacceptable longer run public risk that we bear as long as this is the case. The other problem with it, and this was pointed out by the Deputy Executive Director of International Energy Agency to the Congress in February 2011, and all he's done here is take the oil price over time from 1973 to 2009. He's using 2008 as a base, and red is the oil price in 2008 prices. President Reagan came in, he had a tough run. On the right-hand side of the chart, his energy prices per barrel of oil was about the same as they were when we had the recession in 2008. And it's what he's suggesting with the circles is that every time we hit that level of energy prices on the left-hand side, it pulls a tremendous amount of money out of the economy, out of the GDP over into the energy side, and it tends to push us into a recession with the other things that are going on. And his three circles reflect that kind of an impact, and he has the fourth circle on the right-hand side, and he's asking the question, are we headed for another shock? So just what he's pointing out is just as we're coming out of a recession, we have a potential for creating another downturn in this economy. Also complicating is the global weather situation, which hasn't changed in the last 2 years. We in the U.S., the dark areas are droughts, and the yellow are impending drought or moving towards a drought developing. And the white areas in the last 2 years, we've had too much rain, and what this has resulted in the U.S. is short crops, and we have had higher feed prices. And the brown areas are where a lot of our cattle are grown, and they've had no grass, and they've begun to sell off the beef herd. So we're faced now with the livestock industry looking at heavy input prices of grain, and this is working its way through to our food prices, and they're much higher than normal. And we have the same thing going on in the rest of the world. This pattern simply hasn't broken, and it suggests that an area here that's larger than the U.S. and Europe, Russia and Ukraine, it continues to show moisture problems. So this doesn't seem to be out of the woods yet with regard to this pressure. Now the issue is, how bad has it gotten? And putting all these things together, trying to summarize what we've just seen, suggests that no quick recovery is likely, and that the climate is right for additional pressures to slip in while we're trying to work our way out. Huge household debt going down slightly, huge public debt and private debt, the whole debt, going down very slightly, unemployment numbers down very slightly, food stamps 1 out of 7, another critical indicator, 1 job for people looking, a shift in the wealth income equation, high energy prices again, interest rate exchange rates, who wins and who loses, more clarity there, and a political stalemate. So with all these pressures, a conclusion that one can easily come to is that without further government attention, very slow growth is likely, and generally we would say it'd take about a 4% increase in the economy for recovery and to turn around the job losses that we've seen. You can see this in the chart. On the housing, it reflects very heavy debt and substantial overbuilding. It's still a drag on the market with regard to turnaround, and there is additional concern that baby boomers that are living off of their savings when they retire may have to begin to sell their houses and begin renting if this pressure continues. It's beginning to change the picture just a little bit when you look at the vehicle industry on the other side. The fact is that for the automobiles and light trucks that we have, the fleet has increased in age from about 8 to 12 years, and the fleet is starting to wear out, and so you can beginning to notice a turnaround, and especially the impact of the clunkers incentive program in 2009. But the concern is this: we're taking on more debt to replace the fleet, and we may be creating another debt bubble down the road on debt that we already have. Another way to look at this also, we get longer term forecasts out of our system for the world economies and U.S. economies from Global Insight, so they give them their shot out to 2021. So the blue line is what you would get if you took the real GDP per year and just divided it by the per capita. Notice in the recession, 2009, this line dropped by 9%, so I projected out a trend in front of us at about 1.5% a year, and then compared it to their growth estimate of about 2.6% a year. Now the fact is that bottom growth line at just a little better than 2%, 2% will just about sustain you relative to the new employees that are in an economy. And so the lesson here is unless that blue line touches that red line, we do not recover all the jobs that are lost. And so this suggests, if this pattern is correct looking in front of us, that we're likely to have a massive unemployment situation for several more years in front of us. And then finally, the contributing factor that has us all locked down is over what the government is doing. And in 2008, before President Bush II went out, the Congress appropriated $700 billion for the TARP program and $787 billion for the enhancement program. Put those two together, about $1.5 trillion, about 10% of GDP. And we've had substantial criticism about that since that time. The criticism has been that with the current debt levels, we simply can't afford this level of spending. And to summarize the criticism, we have a government debt overload. What needs to be done is cut taxes and cut spending. We need to straighten out Medicare, Medicaid, and Social Security. We need to cut defense. These enhancement programs are wasting money. The government doesn't create jobs. You've heard those criticisms. And this will just create massive inflation. So it reflects a bit of a backlash both in the public and the private sector. And it suggests that stopping the spending spree and balancing the budget, lowering taxes, and enhancing business is the best strategy for a turnaround, and to make sure that the federal budget is balanced as a starting point. Well, to try to answer this question, when I got into these working groups and we began to look at, well, we've got a kind of a meltdown, and it looks like there's a long recovery ahead of us, what have we done in the past relative to the debt that we have? This is an excellent chart, and probably one of the most insightful for trying to answer that question. This is only government debt. And you notice in 1945, when President Truman was in the office, that he had his hands full coming out of the war. You had 120% debt to GDP. He had a lot of unemployed soldiers. He had a lot of businesses turning now back to the domestic markets. And he had a serious recession on his hands with a serious level of unemployment. And so what he decided to do, even with a high level of debt and with Congress, was implement the Marshall Plan, and we financed rebuilding Europe and Asia. That cost us about 9% of GDP. Apparently that was a good investment because along with everything else that's happening and the growth that took place in the world and the business we got from it, our debt dropped from 120% down to 70%. But Eisenhower comes in, you still have a shaky economy, you still have a lot of unemployment, so he implemented a program like we've never seen before. He was concerned about being able to move his army from one side of the U.S. to the other. It takes about 6 weeks. And he suggested that we needed a strategy to be sure that we didn't risk that security in the future, and that we needed a massive interstate highway building program, and that's kind of how he sold it. Well, that turned out to be 32% of GDP to build an interstate highway system. In today's dollars, that's about $5 trillion. The interesting thing about that is by the end of that program, the highway program had paid for itself. He just simply increased the taxes on gasoline by 4 cents a gallon. The Kennedy-Johnson administration, to deal with the problem, used the space program as the vehicle. That was about a $20 billion cost, about 4% of GDP, relatively small compared to the others. But by the time we were on the moon, we had communication satellites up that were bringing in more revenue in 1 year than the program cost. And then the microchips came out of that, and when you get over to President Clinton, we had the tech bubble that started back there in the 60s with the space program. Things idled along until about 1980 when we had the oil shock. And when President Reagan came in, we had a massive recession and unemployment. And the way he dealt with that was tremendous military expansion and lowered taxes. So you can see that his expansion began to turn the equation around, and we did have debt increasing during his administration, and during Bush it turned down under Clinton. He was a lucky person with low energy and the tech bubble, and everybody thought that we had it figured out with a business model and it would continue in the same direction under President Bush too, only to find out the banking industry had already taken us under, and the oil shock helped close the gates on us. So President Reagan was the first to increase the deficit with his military buildup and low taxes, and so the business model that we thought would be strong enough to make up the difference just simply could not. So just notice that the heavy enhancement programs occurred, and they did complement deficit reduction until 1980, but the change in the direction with the major tax cuts and the defense buildup changed the direction of the debt. It's hard to say what that's worth, because what President Reagan did was up the ante on the Cold War, and he upped the ante so high that it simply brought the Soviet Union to its knees in a collapse. And so what is that worth relative to the cost? But the fact is we changed directions significantly in 1980 in the way we managed the governments since that period of time. So look at the philosophies next. And the answer is that they certainly do make a difference. We seem to have a political meltdown going on with each of these philosophies leaving a lasting imprint. So what we've done on one side is shifted from tight lending to the right side to more lenient, higher taxes to lower taxes, tighter control budgets to increasing deficits, and now we seem to be completely reversing the course. So if you embrace one of those philosophies over the other, this is a pretty sobering chart to consider relative to the consequences of either philosophy. From 1950 to 1980, this reflects the level of unemployment, and the recessions are in blue vertical lines, and the magnitude of unemployment associated with it are at the peaks. And what you notice from 50 to 80 under the first philosophy, that we had, with structural investment, we still, and brought the deficit down, we still had 7 recessions about every 4.5 years. And they tended to grow in magnitude. And so when we get to 1980 and we turn directions to the business model of lower taxes, we had 4 recessions spaced out about every 8 years, and they increased in magnitude until they didn't. And we took it to the extremes and got in trouble with our recession in 2008. So apparently both of these philosophies have strengths and with them certainly weaknesses. So the question that our business meetings begin to turn to is more about what the federal budget looks like and what can be done. What does the federal budget look like over time if we're thinking about a recovery like we have used before? So this chart was put together from 62 to 2010. And it does suggest that the federal budget as a share of GDP is running at about 18%. And in good times, the federal budget is lower, federal cost, and in bad times like President Reagan got into, the cost goes up and then back down, and we get into the problem we're into now, and it goes back up. So apparently the federal budget serves a buffering role. It cushions the blow of unemployment, but with less revenues and therefore more spending. But in good times, the revenue increases with deficit reductions and lower unemployment. So the option that we've been talking about, option 1, that I have continually asked the banking industry and business people, after each session, is given these pressures on the economy, what do you see as a likely consequence if Washington remains in a stalemate over a solution? And this answer I wrote down in verbatim from what I consider to be one of the most successful business bankers that I know, and I wrote down verbatim what his conclusion was, and it was really a shocker to me. He said that he expected over the next several years deflation. He expected a long-term decline in the standard of living, unwinding of the commercial and real estate would be painful. We would have a serious wealth destruction problem, and we were lending money and we were simply doing the same thing. So this was a very sobering conclusion, probably going further than I had thought that it would. So now we tip to the second part, and that is to look at the future with regard to the lessons we've learned. So we've had 7 recessions. So the strategies used from 50 to 79 didn't solve all the problems, nor did the strategies used from 80 solve all the problems. So there's strengths and weaknesses, and the question is, based on these previous programs and the current outlook, what else can be considered to jumpstart the economy? And certainly we've been there before. Here's all the things that we've done. We had heavy debt, but now we have substantial job loss. We got over 50 million people impacted with a massive recession. What can we do? So now we turn to option 2 and ask the question, from lessons learned from the past, what can be applied now to create jobs in this period of substantial debt that everybody's concerned about? And so the reminder here again is, if we're playing the role of government, there are 5 policy levers that we pull: investment, regulation and deregulation. We can control also the budget. We can cut and spend it, and we can change the tax codes if we intend to do so. Now the fact is that we elect public officials to make these decisions, but the emphasis is on us to educate ourselves to better understand these problems, priority and likely consequences, before we send our politicians to Washington. So the first suggestion that came out of this working group, I wouldn't say this was the top one, but it always floated to the top, was pay attention to the energy problem and make it a priority, an investment priority that was well funded over the next 20 years, and it had these kind of objectives: that the energy bill would spill over into the related sectors, and it would provide a stable, efficient, equitable energy supply that met environmental guidelines, and that we would wind up 20 years from now with lower prices. We would be the leader in research and technology around the world, and the spillover into compatible industries would be very positive, and it would serve in their mind as a buffer to the world competition that we're now facing. And so they also felt that this is a way to engage the next generation of scientists. So the second suggestion from the working group wasn't surprising. I thought this probably would have been the first one, but the bankers particularly, and the business people, were concerned that we had stopped the reckless lending, and that we had sufficient regulations to plug the hole. Too big to fail, gotten bigger, still uneasy about it. They're carrying lower capital, uneasy about that. Want to be sure that we have adequate regulations and enforcing regulators, and the Dodd-Frank bill that we have in place now really does plug the holes. The third one, not surprising, was to tame program costs, and just pointing out that Social Security and military is 40% of the federal budget, Medicare and Medicaid is 23%. So those two take up 63% of the federal budget, leaving only 37% for everything else. The argument is that we cannot sustain the rate of increase in the spending in those areas, so decrease the rate, not get rid of them, and that while we're doing that, be mindful of the unemployment with regard to support until job recovery is possible. The fourth suggestion was on the macro side that we've already discussed for more clarity: who wins and loses with a low interest, to spill over with the exchange rate into energy, and the exchange rate with China. More information requested. And finally, the last one is an unexpected. And this came from Banker, and I wrote exactly what he said about the tax code. He said we need to rebalance it across households. One of the big builders said if we don't have this rebalance, my business over time is certainly going to be impacted. We looked at the direction of the divergence in wealth and income. Needs to be seriously reconsidered. Offshore tax advantages for me at home relative to them coming in, and in fact here domestically, big companies seem to have big teams of lobbyists working on their benefit with regard to taxes. Okay, but this didn't satisfy all the questions with regard to whether we could do it or not. I thought by this point we'd have it kind of hemmed in, but the next question they have, okay, if we're going to invest, how much money is lying around? And so this chart's easy to come up with. From 1945 to 2009, we had about 65 trillion in wealth, and it dropped down to about 48, now it's around 55 trillion, and the total debt was about 52 trillion, so about 1 for 1. And there's a major concern about who owns the wealth. 10% have 70% over on the side, the rest of us have 30. And in 1980, 1% only had 20% of the wealth, now 35. So there's a very serious concern about the top soaking up most of the gains since 1980, but the fact is we still have tremendous public wealth. We own the highway system, and nobody knows what the value of public wealth is, but if you just deduce rebuilding the highway system at the price Eisenhower built it, at 30% of GDP, that's equivalent to 5 trillion a day. If that's 1/10 of the highways you and I own, we've got 50 trillion of highway wealth in this country that you and I own. Now add the military bases and the equipment, the nuclear submarines and nuclear aircraft carriers we have, all the public buildings, parks, rivers, lakes, forests, streams, and wildlife. We're the envy of the world, and the taxes we've paid to be sure that we have a functioning government. So the question again becomes, can we afford an high level of structural investment programs with this level of private wealth? I would imagine if you were trying to put a number around this would probably double the value of that number that you see on that chart. So a $5 trillion program, similar to what Eisenhower had, would be maybe 5% of what the total wealth might be in this country. Another way to look at that, if those numbers that we just talked about are too fuzzy, is the top 20 countries in GDP in 2011. The total world GDP was $62 billion. The United States has a $15 trillion economy, and you have to add together all of Europe to beat that number at about 16 trillion. But if you add Europe and the U.S. together, that's half of all the world business in 1 year. All the goods and services sold at retail in 1 year. If you add China and India together, that's 11%, and Russia's only 2.5%. So the question again is, can we afford to jumpstart the economy with similar programs used in the past for faster recovery? And I would say in concluding that understanding the problem is really the first step in finding an answer, and carefully examining strategies and philosophies for strengths and weaknesses offers very fertile ground for compromise and dialogue. The best insights that I've gained were from these working groups asking me for more information on how the current problems compare to the past. And it's encouraging to know that we remain the wealthiest country in the world with public resources and envy of the world, and also that both administrations have embraced similar strategies to jumpstart the economy during similar periods of stress with longer benefits and payback to society, and also finally that all 4 sectors were involved. The government defined the priorities and backed the programs, the corporate sector bid on the contracts, the households provided the labor, and the banks set up the financial arrangements. So in conclusion, after going through this, still a work in progress, I'm optimistic that lessons learned from the past can serve as a base for compromise in the future. And also, in conclusion, that a financial meltdown is very difficult to understand. We have to relearn steps that we've taken in the past to deal with this long-term problem. The shadow is very long from a recession created by debt. And that the fallout is that we have an unacceptable level of unemployment and a stagnant economy with slow growth likely a consequence. And it's easy to overlook the fact that even though we're still climbing out of a serious situation, we remain the single strongest economy in the world, and it suggests to me that there remains sufficient public and private equity to consider investment strategies of the magnitude that we've used in the past to stimulate faster recovery. We've already done that with the banking industry. So in conclusion, I really appreciate the opportunity to share the ideas with you about the economy that's still a work in progress. I know I've gone through this very fast, but I would appreciate your ideas and comments, and thank you very much, Scott, for having me on the program, and for Mark for helping out on this end.
Well, thanks a lot, Abner. This is a great talk. I want to give folks a chance to get their questions in, and also we've got a couple polls for people to answer. If folks could take a moment to tell us a little bit about themselves and their thinking about the presentation. The other thing that I would bring up while we're looking at that is a couple questions that came to mind. folks can put in their questions into the chat box there, and we'll take those as we go ahead. The couple questions that came to my mind is, when you were talking about the debt, a lot of commentators have sort of compared the U.S. to Greece. So, what's your take on that? Are we headed for another, are we going to become the next Greece with our level of public debt? And if so, what's your thinking about that?
Well, the projections that we had in there from Global Insight, Scott, would suggest that we are standing on a much firmer bottom than Greece is, considering the wealth and the public wealth that we own. This is going to be a slow recovery, but we do recover eventually from it. And so it doesn't suggest that we stay here forever, but staying here longer than we might be comfortable with, and it will be considerable pressure for those who fall on the outside. So no, I don't think I would agree that we're anywhere near that category.
Well, that's a relief. What about devaluing? One slide talked about the U.S. government printing money, and obviously one impact of devaluation is that the value of the debt would decline. So, how would that play into your scenarios?
Well, that's kind of confusing territory for me also, Scott. Part of it is devaluing is very likely simply because we overbuilt. And so those houses, the fact that you aren't getting much money in your savings account, compare that to the fact that while it sits there and doesn't go down, hopefully, the value of those houses you go out and buy have dropped by 20%. So that's a deflation advantage, not for those people that are holding it, but for people that have money to buy. The second part of deflation that people are concerned about is just printing money, but what came out of this study for me is that these programs that we've used in the past to stimulate the economy were really investment programs. It's kind of like you've been in serious trouble and you happen to find that golden goose that bails you out. And most of our investment programs have been very, very carefully thought through, and they have accomplished a lot of positive things with a long-term downstream to it. So I think if we were to turn that towards something like energy as a priority, as they suggested, or some of the others, that we would find quite a different story coming out of the fact that the government can stimulate investment. Now, the fact is, we hear the statement said the government doesn't create jobs, but I don't think when President Eisenhower put together the program to build this interstate highway system that he turned a shovel of dirt, maybe one, but all that was done by the corporate sector, and the banking industry financed it, but the government simply backed it and supported it, and the households benefited from the jobs, and the long-term consequences are very positive. So it has two parts to it, and I tend to lean towards that latter part because that's kind of where our discussions have gone so far.
Good. Have you thought at all about the role of demographics in all of this? You talked a little bit about in a few slides about the kind of the changing distribution of household income between those that the top 10% or the top 1%, depending on which slide you're looking at. We're very dependent as a country on immigrants. Our population would actually be declining without immigration. I believe the latest figures have shown that. I need to double check that, but it certainly would not be a growth situation without the immigrants. And the immigrants tend to come in kind of at the bottom of the labor market and without a lot of household savings. So what is that? And if that trend continues and the sort of the U.S. born population continues to age and decline and is replaced by immigrants, how does that kind of change your long-term projections for how things will play out?
When I talk about that with some of the congressmen in Washington, Scott, they say we're schizophrenic over that issue. And in one sense, we just can't do without immigrant labor. In the other sense, we look at it as being competitive and we don't want it, and we just can't come to conclusion, a balanced conclusion about either one. So a lot of migrant labor and immigrant labor is necessary for many of the jobs that we have. And here in Columbia about 10 years ago, we had a hailstorm, whacked out the roofing on just about every house here. And if it hadn't been for the immigrants coming in, we would have been sitting around a long time without our roofs repaired. So they are certainly a positive part of the equation over time, in my opinion.
But wouldn't that also kind of exacerbate these trends towards, greater concentration of wealth?
Well, I think that would go towards the tax code and what we're able to do about changing that. The fact is that when we lowered the taxes in 1980, the criticism was that we had a graduated tax from 30s to 1980, and the higher you got in the income bracket, the more taxes you paid. That tended to moderate that divergence that took place. So I would see that to be more of an issue of what happened with the tax code than to get into whether it begins to creep into our job availability here on the domestic side.
Okay. There's a couple of questions that came in via the chat. I'll answer the first one from Alan. Generally, Alan, we post the slides right next to the webinar recording, so you can have them as a slide set standalone, or you can play back the audio as well. So you can just go to the archive down at the bottom that's listed there at the bottom, and you should be able to find both. In terms of converting to PDF, I think it would be in PowerPoint, and then you'd need to convert to PDF on your own. You can let us know if that's an issue. Abner, do you want to talk about maybe Marilyn's question that talks about the one of the problems that I think all of us recognize is that people are not looking to the long term in today's political situation. You talked about a little bit the gridlock there. What's your perspective on that, of kind of trying to get people to think a little bit further ahead?
Well, that's the reason I really divided it. Thanks, Marilyn, for that question. It's really the reason I divided it in two parts. If you'd have heard this last year, I only got to the first part. And my wife was with me. In a program, and she said in the meeting at the end of the program, Abner, if you can't come up with better answers than this, I'm not coming with you to another meeting, and I don't think these people are going to want to hear you. It's just doom and gloom. And so that's when I went to the second part, Marilyn, and began to ask the business and banking community and lawyers and my colleagues, what should we do? And every meeting we kept going back to what have we done. And I think the answer to try to change that is that we're just going to have presentations like this. And I'm encouraged by it because when I go out and give presentations here in the state or in neighboring states for my outlook with agriculture, and I'll do what I just did with you, and I know that there are different philosophies sitting in the room, but it has been amazing to me. I'll say this is a 45-minute presentation, it's over, do you want to hear any more? And I will be there from 8 till 10 and longer if I would stay. And I keep thinking about why that is the question, and many of them simply remember all of those things that we went through and that we've done more, and they know that it went across both administrations. And so if you embrace one administration or president over another, both of them used exactly the same strategies all the way through Reagan and Bush won, and Clinton didn't have to. He just happened to be lucky, and President Bush too was very unlucky to be sitting where he was. So it seems to me that Sandy, my wife, was right, and the business community I began to work with and colleagues here said, this thing is too much like the Great Depression. Same thing occurred. We just don't know enough about a financial collapse and how to get at it. And that took me 6 months to work out this final set of charts that you have there with the interchange that I got with them. And the encouraging thing about those meetings, besides when I go out and give the presentation, it'll go an hour and last another hour, sometimes late in the evening, but with the working groups, about 30 people in the room, very successful business and bankers, they would only sit and listen for an hour. Then they started to go in for 2 hours, and the last 3 sessions we have started at 10 and went till 2. And so all of us were caught up in this second part of not knowing. And I think you can say, why have we gotten caught up in this game? And my answer is, if you don't really know the reasons why, then the extremes are going to pop up first, and they're going to take the main part of the news media until the middle begins to show up, and it's taken me this long to get here. And I work in this game. So I can't expect the politicians and others who do all the other things that they do to have gotten much further along, or maybe I'm just a slow learner, but I really haven't found anybody else that I can turn to that really seems to have all the pieces put together. And I wouldn't say that I have yet either. So more education along the lines that we've just discussed, Marilyn. Thank you.
Oh, great answer. And then Joe Stellato, I had a question about, basically the argument about taxes and jobs. So maybe talk a little bit about that.
Well, the reason for covering the two philosophies, Joe, from 30 to 1980 is that we had one tax structure and we had one set of outcomes. And then from 1980 forward, we had another tax structure. And what we were really leaning on with regard to that tax structure was a financial business model, and I didn't realize quite as much that that model really was based on lenient lending. But when that was sold in 1980, when I was around as an economist listening to it, I had a lot of concern about the selling of it because it sounded to me like that we were taking the lead to be the business sector is going to lead the economy. Well, the fact is, if you invest in the market and you go out right now and decide you're going to build something or invest in some major industry, you better be careful, because if the consumer isn't buying, that industry is not going to do well. And so in the process of moving to where we are and to how we've gotten here, most of the gain in the income and in the wealth went to that top percent. So it's a stacking at the top. You and I put our 401k in a savings plan, and here Fidelity gets to use all of that plan. It goes through them directly. So you can set up your own investment plan and bring in a lot of money, and very few people controlling that money make a tremendous amount. Those big investment banks, loan at 2.5%, carried no reserve, very little reserve, and they paid themselves huge bonuses. And we got big companies, the tech companies and specifically, offshore, bringing their product back that we're buying them, but they're leaving their money offshore, want to bring it back in at 5%. So there definitely is a situation where it has been overdone. And apparently it has gotten out of hand at the top level. And it's simply out of balance. And if I'm a domestic producer, I can't guarantee myself that what's coming in from outside and what's already here with regard to the advantages the big companies can find is going to leave me a level playing field. I don't say do away with it entirely,